activities including ropes courses, rock climbing, and zip lining. Company offers unique experience for team building activities, camps for youth, and anyone seeking outdoor adventure. You're the accounting manager. Your staff submitted the following trial balance for the year ended March 31st. In your review, you discover the following additional information has not been included in the trial balance. So prepare the missing adjusting entries for A to D. So this is a review of before the midterm. You will have to do adjusting entries once again worth 10 marks on your final. So it will be on your final 100%. So you can't forget it and move on. So we'll do a little bit of a review here. So this is March 31st, 2017. And that does it say for A. On April 2nd, you received the telephone bill for the month of March for $300. Which accounts are going to be affected? What accounts will not be used at all during adjusting entries? Cash. So accounts payable and telephone expense. And will accounts payable be going up or down?
Up, credited.
Credit. And telephone expense?
Debit.
Debit, yeah, it's going up as well. So we can go ahead and put that in. On March 31st, Adventure Element took a university student club ziplining. An invoice had been sent to the student club for $2,000 due April 30th. So, which accounts will be affected? And? Revenues. Is your receivables going up or down? That's right. And your revenue? And how do we make an asset go up? And a credit go up? Or sorry, yeah, revenue go up? Yeah, credit. So we can go ahead and do that. Record, was it yes.
We have that one, so if you can see.
On March 31st, the company held a teens camp for $1,500. All tickets have been prepaid 2 weeks in advance. So which accounts have been affected? What is the date here today? It's March 31st today, so the company just held the teen camp today. So 2 weeks ago when we accepted their cash, what did we do? We debited what when we took the cash in? cash. And what do we credit?
Unearned revenue.
Unearned revenue, because we haven't done the work yet. Today we did the work, so what do we need to, accounts do we need to use?
Unearned revenue.
Yeah, we need to. And what do we turn our unearned revenue into after we,
Revenue.
yeah. So is our unearned revenue going up or down? Down. And our revenues are going up. How do we make a liability go down? And a credit revenue. Awesome. And it was $1,500. The equipment has an estimated useful life of 20 years. If you need to create a new account, use account code 606. So, looks like there is no depreciation expense. So we can make one up. So which accounts will be affected?
Accumulated depreciation and depreciation expenses.
Like, Evan, will you come across a financial, like or a statement like this, where it has accumulated depreciation equipment, but not just a regular depreciation equipment account?
Yeah, like if there's a new asset that your business, if there's a new asset that your business acquires and you're doing your first set of adjusting entries, you'll have to create an account. I mean, this probably doesn't make a whole lot of sense because they have the accumulated depreciation there. So that probably
Yeah.
wouldn't happen, but I don't know.
Yeah, that's what,
They're trying
so
to,
would you add those accounts together or no?
no, so we'll still use this accumulated depreciation account and keep that balance. And this one, I guess they haven't added back because the balance was 0 from when they closed it the year before, and they haven't done their adjusting entries for depreciation yet. So it's just not showing here, I guess. But yeah, don't worry about it. It won't be on the midterm like that. I won't do anything like that. I won't try to confuse it. So our depreciation expense is going up, which is a debit, and our accumulated is going up, and this is a contra asset, so it's the opposite of what an asset would normally do. So we can go ahead and we got to figure out how much to do here. I'll enter the codes and then we'll figure out how much. So depreciation equipment. And we need to figure out how much. So the equipment has an estimated useful life of 20 years.
1,100 per year.
Okay. If you need to create a new account, yes. So equipment, 22,000 for 20 years. So our straight line method, it says nothing about residual, so we're going to assume $0 divided by 20 years equals 1,100. Equals 1,100. So what we need to do now is we just need to adjust our totals, right? So the first one, we debited telephone expense for 300 and accounts payable, we credited for 300. So we just need to change those. So this was 2,000, it's now 2,300. And accounts payable was 2,300, it's now 2,600. AR and revenues both went up by 2,000. So it was, now it's 7,100. And revenues is now 63,015. Unearned revenue and revenues went up 1,500, or unearned revenues went down 1,500 and revenues went up 1,500. So unearned revenues is now 9,100 and revenues is now 6,415. And depreciation expense went up 1,100 and accumulated depreciation also went up 1,100. So this is a 1,100 debit, and our accumulated depreciation is now 7,000. So we just need to adjust our accounts, right? So we would normally do this in the posting phase, but we don't have a ledger handy, so we're just writing over our balance. So it's asking us to do a adjusted trial balance. So we'll go ahead and do that, even though it's just going to be exactly the same as this, but just to show you how. So what is it called? It's the adventure elements. Adjusted trial balance on March 31st, 2017. And we can go through. So accounts payable is 2,600. Accounts receivable. You know what, in the essence of time, I am just going to not do this because we're just copying out this one that we already have here. So, I mean, this is a trial balance. We've made our adjustment, so this is our new adjusting trial balance. We do have to include this expense into here. But it's going to take 15 minutes just to copy it out. So you have got to start, and you can see what happens. Let's get into the closing entries. So what is our acronym that we want to use? REID. And it's revenue to, expenses to, income summary to, draws, March 31st. What do we have for revenue accounts? Just revenues. Has a credit balance of 6,415. So how are we going to make that zero?
Revenue debited to income summary.
Revenues, we're going to debit it for 6,415. 64,515, sorry. to close revenue accounts. So that is revenues. What's next? Expenses. Now we've got a number of expenses. 2, 3, 6, 7, 8 expenses. They all have debit balances. So what do we need to do to our expenses? Credit them. So what are we going to debit? Income summary. That's right. And we can start listing out our expenses. And I'm just going through finding all the expenses. Now again, it's easy because they're all coded with 6. You won't have that luxury on the exam. So don't get used to it. And we can balance it on the, is that all 8? Yes, it is. So we can balance it on the, with the debit to income summary. If someone wants to add that up for me, that'd be great. 50,245. To close expense accounts. So we've completed the E. I is income summary. So how can we determine income summary total? What handy little tool can we use? Yeah, T-chart. First thing we did, remember it has no balance until, because it gets opened and closed just for closing entries and debited. So what is our balance?
40,270.
That's a credit balance. What can we do to make it go to 0? To balance? Debit it. That's right. And what are we going to credit? Yeah, Becky Brenner Capital. Alright, so we've got that, and what's our last one we need to do? We have withdrawals here of 31,200, and it's a debit balance, so how can we make it balance to 0? Credit it for 31,200, and what are we going to debit? That's right, because withdrawals to capital.